Hello, this is David Daughtry, and we are going to talk today about China. One of the things that has been top of the news all around the last 2 or 3 weeks has been Greece, and everybody's talking about it. It's on CNN, it's on Bloomberg, it's on CNBC, but the reality is that Greece is less than 2% of the GDP of the Eurozone. If you look at China, China is second only to the US in global GDP. And not many people have been talking about China. Only in the last couple of weeks have you started to hear anything. But we think it's much more important than what we're hearing out of Greece and the Brexit and everything else. So what I'd like to talk about a little bit on China, we'll start out by looking at the Shanghai Composite Index. And this index, this is a chart going over the last year up until a month ago. And what you see is from July of 2014 until June of this year, it's gone from about 2,000 up to 5,000. Sounds a lot like the NASDAQ in 97 to 2000, where the NASDAQ went up above 5,000 from about 2,000. If we look in the next year, not in the next year, in the next month, what we've seen is in the last 30 days, it's gone from 5,200 all the way down to about 3,700, dropped 20 to 25%. That's a dramatic drop, about $3.5 trillion of market value wiped out, not only in Shanghai, but Shanghai, Shenzhen, and the Hang Seng, which is Hong Kong. If we look at the valuations, like in Shenzhen, they're a price to earnings ratio of about 100, and that compares to historical averages in the U.S. of about 15 and current averages of 17 or 18. So very, very overvalued from that standpoint. When it goes up more than 100% in a year, it's going to get ugly, and it has. I mean, we saw the NASDAQ in 2000 through 2002, those 3 years actually going down nearly 80% to its low. If we look since then, or for the full time frame, we went way up, we've come down, and now we're starting to recover a little bit here. That recovery is mainly being pushed by the Chinese government. As their control and command economy, they don't like things that don't go the way they're looking at it. And I think when you look back and say, well, why has this occurred? One of the things that I think comes into play, because the Chinese market has dramatically underperformed the rest of, like, the S&P 500 for 4 or 5 years. Only in the last year has it gone up dramatically. Some people would say, well, it's catching up. It's probably not. I think what you're seeing is for the last 4 or 5 years, you've seen a lot of speculation in the real estate market in China, and the central bank and regulators over there have made it more and more difficult to borrow money against real estate. In fact, some of them have made it so that you have to have 70 to 90% equity if you're buying a third or fourth or fifth house. So I think what's happened is some of the investors have just looked and said, hey, what we'll do is we'll just go out, and we know we can still speculate and borrow money on stock. And in contrast to the U.S., in China, you can actually put real estate up and use that money to borrow to purchase stock. So why does margin matter? Well, margin is nothing more than borrowing money to finance your stock purchase. Typically in the U.S., you don't see that much of it. What you typically will see in the U.S. is you will see somebody that wants to buy $100,000 worth of stock, they'll put $100,000 in a brokerage account and buy the $100,000 worth of stock. But what can occur, and does occur here to a small extent, but a lot larger extent now in China, is that I can put $50,000 in and buy $100,000 worth of stock. Well, that's great when it's going up, but when it's going the other way, it means for every dollar the stock goes down, I lose $2 of equity effectively. And so that can be very painful. And when we start looking at the margin, and that's the borrowed money to use to buy stock, This is looking at it as an outstanding balance of the percentage of, and here it's a lot of verbiage, of free float of the Shanghai Stock Exchange. Just means the stock that is available for trading, because some stock is not. Some's tied up in treasury stock. The state in China may own a big chunk of a company, and that's not available for trading. So this is as a percentage of the free float. 3 years ago, it was 2%. Today, it's gone all the way up to 18%. If you look at the New York Stock Exchange, it's between 1.5% and 3% over the last 25 years. So if we go back and look and say, wow, that was 2%, which was very similar to what we saw in NYSE, now they're 18 versus 2 or 3. You go to Tokyo, and what you see there is it's less than 1% right now. And so that's what you're seeing. If you look at what's happened when they've tried to go ahead and put tightening on the margin requirements, then what you see is you see more and more volatility. You don't see that typically here in the U.S. And if we look at some of the other markets, Korea, Taiwan, they're very similar to the U.S. So it's not an Asian or a Pacific area that everybody does a lot more margin. They don't. Korea and Taiwan are less than the U.S., but you see this just dramatic exponential rise in margin, and that's a clear signal that there's lots of speculation. So when we look at that, that really brings back of why is their market, has it gone up, and when it starts coming back down, it comes down very quickly. Now, what's occurring and why are we seeing this bounce back? Does that mean it's just going to go right back up? Well, it scared the politicians over there, and they're trying to reflate that somewhat because I'm sure they're concerned $3.5 trillion of wealth goes away, you can get civil unrest. And what they've done is they've loosened the margin requirements a little bit to keep it from plummeting, but they've also done some things that are pretty draconian. If you own 5% of a company, considered a major stockholder, they've imposed a 6-month moratorium on you selling any of your stock. So the concern there is that if I can't sell my stock in China, I may sell holdings around the world to increase my liquidity because I can't sell my main position in China. And that could cause some downward pressure. The other thing that they've done is their National Social Security Fund, which can invest both in stocks and bonds, they precluded them from selling any stock. They have also announced that they're going to criminally go after people who have recklessly shorted the market. What's the definition of reckless? I think depending upon who they want to go after, that's what it's going to be. I think that's a way to try and keep people from shorting the market. The other thing that I heard just yesterday was that some of the investors, retail investors, have said that when they've called in to sell stock, that brokers have refused to take sell orders, which is kind of bizarre and scary. But that's in a control economy. That's not out of the ordinary. Now, why are we concerned about this? Well, $3.5 trillion of global wealth, going vamoose in 30 days is a big issue. But also they're not allowing any IPOs in that market. So if I'm a growing Chinese company, I may not be able to get as much capital as I could. So I may not grow as fast. And I think you're seeing some of that slowdown that's being manifested in the price of copper in the last couple of years, and aluminum, cement, iron ore, and that's hurting a lot of Latin America. Latin America that was growing 6 or 7% 2 or 3 years ago, probably going to grow less than 2% this year. So it could have some global impacts, not just in the stock market, but economically. And so that's why we're looking at it. We're not panicking, but we're also not looking and saying we want to jump in there, because a lot of people do also have a lot of questions as far as the veracity of the data that's coming out of China. So anyway, that's our concern right now. That's why we wanted to talk about it. We hope you enjoyed this. We'll be talking on some future Dave's talks about some other markets that we are looking that are interesting for various reasons. So thank you for watching or listening, and we hope to talk with you soon. Thank you.